Hey there, macro folks. This is Mr. Hooker, and this is the second video for Chapter 14 Money, the Fed, and Interest Rates. So let's get on into the action. Federal Reserve independence. It was established by Congress as an independent agency, which protects it from political pressure. Like I said before in the last video, the Board of Governors get one 14-year term. They cannot be removed. It is one of those things. So they have no, once they're appointed, there is no real political pressure. The chair, the one thing I need to mention also, the chair of the Fed is appointed by the president. And it's always like the February after presidential elections, and so they are 4 years. And then once you're appointed chair, you've got that 4 years until the February after the next presidential election. You are the chair. You also cannot be removed during that time frame. The president's either picking from the people who are on the board, or if there is an available opening, they can appoint their own person, get them confirmed, and have that person be the chair. It's kind of the way that works out. Um, it enables the Fed to take the actions to increase interest rates in order to stem inflation as needed, without worrying about people being all upset and saying, well, you folks are doing bad things. We're going to have to remove you. Like, yeah, go ahead, try it, whatever. It's okay. It was kind of funny during Trump's presidency. He actually put Jerome Powell he appointed him, got him confirmed, made him the chair. And then, I don't know, a year or so into the term, he didn't like the things Jerome Powell was doing, and he called him to the White House to chew him out. And he was saying in the media that he didn't like what he was doing. He was going to call him to the White House to chew him out. Powell was just like, yeah, I'm not going. Yeah, yeah, no, that ain't going to happen. We're not going to do that. I'm going to stay right here. And so it was just kind of funny, the power dynamic that had shifted, that Trump did not understand that the guy he had appointed really just, it didn't matter. He was going to be there for 4 years as chairman, and he was also going to be on the board for 14. Didn't really matter what you think. It's just going to be done. So that's really just kind of interesting how that went for that. The fractional reserve banking system, that all started with goldsmiths way back in the day. Goldsmiths were typically on the end of the town. You would put your gold in with them. They would write you a receipt, and instead of going to the end, all the way to the end of town to get your gold, you would just take your receipt to the store, and people would just write on your receipt that, hey, you used X amount of gold with this shopkeeper, you used X amount of gold with this shopkeeper, and you would sign it and basically sign something, and they would go down to the end and get that taken care of with the goldsmith. The goldsmith would keep the books on that, and the goldsmiths realized, hey, nobody's ever coming down here to get the gold, so we can loan this stuff out, and that became the first fractional reserve system. So that's really how that is. And that's what banks do. They create money through lending because not everybody's coming for their money at the same time. But banks are subject to panics. Ask SVB. They went down, and then another one went down. And the idea that we don't have reserves now makes that a little more likely. The things I have read is there are probably 200 to 300 banks right now that are in the same boat as SVB, and all they need is something to go slightly south. And then we probably have half the banks in America right now that are insolvent, um, and just need some sort of catastrophe. Having worked in banking for a while, I understand how this could happen. And I worked in banking when there was a reserve, requirement. But there is a lot of moral hazard in banking. And there was a lot of moral hazard in banking because of the FDIC. And so, and the idea that the government will always bail you out. And that needs to end, in my opinion. Like, the government needs to quit bailing banks out and just let a number of them fail and just not bail them out and let it go. And if that happens, a lot of the moral hazard will go away. Like we'd have people making bad loans at the bank I worked at, and they'd just be like, it's okay. These people have FDIC. It's okay. Don't worry about it. And that was their mantra. It's all right. The FDIC will bail these people out if things go south. And that's the mantra for a lot of banks. And that is just sad. So just saying, um, a lot of people may not agree with me, but the government needs to let some banks fail. And that'll sober up some other banks. And this whole idea of the government will bail us all out will end. So the Fed influence over lending and money system. The Fed can alter the money supply by modulating the incentives and the restrictions it places on the banks and thrifts. So the policies prompt the banks to increase the lending and access to credit is easier. So they do send out some policy notes and say, hey, um, we'd appreciate it if y'all would lend a little bit more. And that is just known like, hey, we would like you to lend, and we'd like you to lend to these groups, and it's very explicit what they want you to do. Now, whether or not you do it, that's another thing. But and sometimes you lend, but you won't lend to the groups they want you to lend to, and it's a money thing. Um, and so there's also Fed policies which prompt banks to decrease lending, and that results in a lesser volume of loans and higher interest rates. And we'll talk about that more when we get into monetary policy as well. Um, Interest is the price paid for the use of money. It is nothing more than the price of money. Yes, there are a lot of different interest rates, but we are going to act in this chapter as if there's only one interest rate. We're just hitting that easy button again. Determined by the money supply and money demand. Um, so there's two basic demands for money. There's the transaction demand for money, which is determined by nominal GDP at the moment, and that is independent of the interest rate. People need money to buy things. You need money to buy groceries. You need money to pay bills. You need money for other things just to survive. You got to pay rent. You got to pay your car payment, etc. Those things cause transaction demand. Then there's the asset demand for money, and that is money as a store of value. That is speculation. If interest rates are low enough, you will basically buy assets and hold them as they rise, right? So varies inversely with the interest rate. Um, so as the interest rate is low, we will hold money. And as the interest rate is high, we will not hold money. If at high interest rates, we will put our money in savings because that is a good rate. As the interest rate is low, there's no use in putting our money in savings because we're not really earning interest. So that's how that goes. And then we have the total demand for money, D sub M, which is that total demand. So the equilibrium interest rate changes with shifts in the money supply and the money demand. The interest rates and the bond prices are inversely related. Bonds pay fixed annual interest payments. Lower bond price will raise the interest rate. Um, really, the interest rate changes the bond price, not the other way around. So basically, look at it this way: you buy a bond that pays out a semi-annual coupon at 4%. $1,000 bond with a semi-annual coupon at 4%. If the interest rate changes to 6%, then now your 4% bond is really not as valuable as the new 6% bond, right? So you would have, if you wanted to sell your bond, you would have to sell it at a discount because nobody wants your 4% bond because they can easily go out on the market and buy a 6% bond, and that is going to pay them more semi-annually than your 4% bond. However, if the interest rate falls to 2%, your 4% bond is going to sell at a premium because now all people can get on the market are 2% bonds. So you can sell your bond now at higher than the 1,000 you bought it for because you are making more money than they can get on the market. That is how this actually works. So as the interest rates change, if the interest rates go down, your bond price goes up. If the interest rates go up, your bond price goes down. So the last word on this: cryptocurrencies, Bitcoin, Ether, all those things, blockchain. Blockchain is just a sequence of updates that tracks the ownership of digital money. Um, the central banks are trying to get digital currencies out there, um, and those may eclipse private cryptocurrencies. So right now, we in the U.S. are working on a central bank cryptocurrency, and I believe China is working on one. And those, you know, the idea is try to get those regulated and get those in there. We'll see how that works out. That's all for now. We will see you in chapter 15. Take care, folks.